Prateek, good to have you back on ET Now. Thank you for joining us. Prateek, the month of September has been a very rewarding month for Indian investors. But looking at the way how things have moved for Indian markets in the month of October, do you think the best part of the rally is now behind us?
Yeah, in the month of September, two things happened. One, there was this flurry of monetary easing across the globe. Every time that has happened, Indian markets have done well for a period of time, and September was such a month. At the same time, a slew of reform measures coincided with the monetary easing, and a pretty large section of the investing public started to believe all of the rally that we are having is because of reforms. But fact of the matter is, quite a bit of the rally might have happened because of QE, and if we really dissect and see which parts of the markets have moved up in terms of indices, my sense is the larger caps have done much better, the liquid names have done much better, and those are the kind of names which may be present in various indices, MSCI, FTSE, Nifty, etc. kind of indices, and would point to ETF kind of monies rather than long only India dedicated kind of monies. So as that effect wears off, it's always happened after a period of 2 to 3 weeks. We could see a degree of correction in the Indian markets. Now, in the month of October, this is the result season. We have to grapple with two of these things. One, the ETF flows, the fact that QE has been some time back, and now the effect needs to be easing off. And second, in this quarter, the numbers may not be as good even as the last quarter. While overall growth may sustain, but the markets may just get narrower. So it would be a time wherein market can just take a step back. So, but that is for the immediate term. We do hope that over the next 10-12 months we hit a new high on the index, if for nothing else, just for earnings momentum that we see going forward. And at the end of it, reforms have happened, and there has been improvement in some sectors. So there the valuation should sustain at a higher level.
Prateek, do you think earnings this time around can help lift the market sentiment, or are they going to continue to be sluggish?
No, my sense is earnings would be narrower this time. So versus last time when two-wheelers did okay, all FMCGs did okay. The sense is that this time two-wheeler results would be weaker. In food companies may not be able to deliver as good a number as they did last time. So even the very high quality part of the market, which has been delivering great numbers, may see some of the companies chipping off. So while overall the numbers may look good, because this time one-off may be lower, but the width of the rally, width of the good numbers may be even narrower than last time.
So Prateek, are you bullish, are you bearish? I'm afraid based on your initial comments, you are clearly hedging yourself.
No, we are bearish versus the guys who are extremely exuberant, but we are hopeful. So if you look at our portfolios, we have still not opted to take any bets on the risky part of the market, any bets on the levered part of the market, and so on. So we would still want to wait. We believe valuations there have moved up pretty sharply, and may not be sustained by the immediate set of numbers that we will end up seeing.
Which means you are not taking, you're not booking profits in pharma and some consumer names, so you are still holding on to your Sun Pharmas and Divi's Lab of the world?
We did not have any pharma name which had an overwhelming domestic presence. If we had one, we have sold that off. Most of our pharma names have most of the businesses coming from overseas markets, and yes, we continue to have faith in that pack. We believe that's a space which offers the best risk reward at this point in time. Yes, DPCO, if it goes the cost way, is going to be a negative, but for businesses which derive most of the revenues and profits from overseas, that should not be too much of a bother. For FMCG, we are actually not overweight versus the index. We are more or less in line.
Pratik, just a one-line answer and then I need to take a break. Infosys tomorrow, do you expect a surprise or a disappointment? Just a one-line answer.
Come again?
Infosys Technologies, what do you expect tomorrow? Surprise or disappointment?
Okay. No, we believe the expectations are much more rational, subdued this time around, so we expect the market to be surprised positively rather than negatively.
Pratik, what is your expectation in terms of what the PSU banking lot is going to do?
I think there we are not very positive on the PSU space. They would benefit from lower treasury yields, almost definitely, because the duration of their portfolios are longer than those of the private sector banks, and yields have gone down. But I think the stress on the NPAs would remain, and frankly what I do is to look at the numbers. If NPA levels had been constant over last 1 year period, and if you do that, then you would find that most PSU banks, if you provide for 70% of the incremental NPAs they registered, may not have been able to show any profits at all last quarter. So we are not very positive, frankly, on PSU banks.
So at the current juncture, if you have to construct a portfolio where, if you have to put in 100 and if you want 130 back, you want 130 back in next 12 months, how would you construct that kind of a portfolio?
Okay, so I think in terms of risk taking, we would want to be pretty heavy up on financials, mostly through the private sector side, but from the also from the infrastructure NBFC side, which is a place where because of the packages which have been announced, the fear of NPAs has clearly reduced. We would have a pretty high weightage on pharmaceuticals, the export-oriented ones. In terms of quality of businesses, in terms of the valuations that are presented, they offer a pretty good combination. So between these two sectors, close to a 50% kind of a portfolio can be constructed. We would have decent exposure to IT. This is a very high quality space in the Indian market, and today is building in growth expectations which are way lower than market averages. So you have this dichotomy wherein businesses which have delivered or always delivered growth better than the market is having a spot of bother in the immediate term, and markets have thrashed down valuations to levels which are actually at a discount to market averages. So I think over the medium term it offers reasonable upside. So some bit of the portfolio would have IT, and the other bit would have businesses like insurance. Those would be more bottoms up stock ideas from insurance, from auto anch kind of a space where they have IP and where they have pricing power. And maybe also a few businesses from the agri space.
Even though in this year we have seen, an incredible run-up in FMCG and pharma names, if I map the market movement, that is one pack where stocks are making a new all-time high. ITC is sitting at a new high. HUL is marching towards a new high. So, the consensus on the street till about 2 weeks ago was that it's time to sell FMCG, it's time to log out of pharma. But if I look at the price movement, it's only FMCG and pharma which are holding on.
No, so just because the stock has hit a new high doesn't mean the stock has become expensive. Because frankly these are spaces wherein earnings have been compounding very nicely over a period of time and are expected to compound going forward as well. So just because something else has fallen doesn't mean this space needs to fall as well. This is also a space which almost never needs to raise money because of the capital efficiency of the business. and hence the stock keeps getting scarcer and scarcer. So just because the other part of the market has fallen, to say that this needs to fall, I think is jumping the gun a bit. If we do valuations based on DCF, two-stage Gordon, or whichever valuation methodology one may choose to adopt, my sense is today even the most expensive stock in the market would offer an upside. Okay, and yes, the thrashed out part of the market also offers upside, and maybe more upside than this part of the market. But in periods when you are looking at earning certainty, visibility over the next few quarters, clearly you would end up paying some degree of premium for certainty rather than where there is no certainty. The thrashed out part of the market, incidentally, is the part which is either mineral mining related, where because of global slowdown the outlook is not very good, is maybe real estate construction related, where the balance sheets are extremely levered, and so on. So there the outlook doesn't seem to be improving quickly.
How exactly are you approaching infra names? Are you looking at buying builders, which is a low margin but a predictable business? Are you looking at buying asset owners, because if interest rates are slashed, asset owners will make money? Or you want to keep it safe and simple, stick to machinery companies, stick to capital good names, because they are the first ones which will be off the block if capex cycles, if the capex cycle picks up?
Okay. We are exposed to this space, but through some of the best names in this space. When you speak of this space, the names that come to the top of the mind would have a degree of leverage which cannot be sustained by ongoing operations. So how many ever number of houses one can build and sell, you would find some of the larger names in this space just can't bring down the debt levels. So unless in the housing space people decide to monetize assets and bring down debt, we are not interested. In terms of the assets that we like, if at all we have to go to asset oriented businesses, it is cement and power that we like, and in that order. The valuations for cement seems to be holding on quite well, and power is something where there are reforms, and maybe from depressed valuations today there is a chance that valuations improve. So if at all we have to look at that space, maybe look at names in power or cement space. Otherwise, as of now we are not, like I said, exposed at all to this space. For capital goods, one can hope against hope that things will happen, but we need to have reforms on mining allocations and on land reforms. Only then can we see actual, fresh new commitments on the ground. And mind you, some of these names will get orders 5-6 months after that. So it's a long haul from here till the last data point that came in and that I saw. Right. The trend in capex was down, it was not up.
When you say you like power, what exactly do you like in power? Do you like names like JSPL, which are fully integrated, they are dependent on merchant power? Or you like, government PSU power generators, names like NHPC and NTPC?
No, hold on. So, I will not be able to talk names, but I will give you the framework. One, in the immediate term, our sense is that nobody will be able to do merchant power. People will have to tie up power for either the medium term or the long term. Okay, and most of the power that they will tie up this way may have fuel pass-throughs. So it will be capacity charges that people will try and obtain. That said, people who have already got coal linkages or have captive coal stand a better chance of making higher profits, but the profitability, the return on capital would be lower than what it is today. For incremental plants which come up in the future, one should expect between 16 and 20% kind of returns. And that too risky. Earlier in the power space, the generators were guaranteed a particular ROE if they met some operating parameters. That guarantee is going away. So my sense is that if you get a business here which has fuel tie-ups in place and has tied up medium to long-term power, and is available at sub one-time price to book, then it may make sense to buy that space. Otherwise, it makes sense to stay away.